Neill Dutta, Renaissance Macro, can you model positive real wages into the end of the year?
I think that's probable, but I think that's largely because inflation is going to be slowing, not because not because nominal wage growth is going to accelerate. So I think that compositional story is important. My optimism around real wages improving is largely because I'm more confident, I think, relative to consensus, that inflation is cooling throughout the remainder of the year. If you look at what we've seen over the first quarter, obviously it was a very strong quarter for inflation, as we all know. And believe it or not, real wages didn't actually go up all that much, if at all, in Q1. So I think we have to be careful here about kind of tying the firm inflation, because right now, Tom, it feels like to me that people look at the consensus looks at the strong inflation numbers in the first quarter as reinforcing kind of like this inflationary boom-like dynamic in the U.S. economy. But I think when you take a step back, we do know that wage growth has been moderating. Most of the forward-looking indicators that we look at, things like the quits rate, posted wages, suggests further cooling in nominal compensation growth. If you have this sort of inflation continuing, you do need to start worrying a little bit about what that means for real wages, and in turn, what that means for consumer spending and corporate earnings. So, fortunately, I tend to think that inflation will slow, but I don't necessarily look at, the inflation data in the first quarter as kind of reinforcing the stronger growth outlook. I actually think it presents a risk if it continues.
All right. So, Neill, we've had a busy economic release schedule over the last 24 hours with Q1 GDP and then today's inflation. Can you wrap it all up for us in how you think the Fed is going to look at the last 24 hours worth of data?
I think they'll look at it and say, we have nothing to do right now. This sort of reinforces their belief that they have the benefit of time. At the end of the day, we have strong jobs growth and firm inflation. That's not a reason for them to cut rates at the moment.
So, all right, so let's kind of look ahead a little bit here. I mean, what is the inflation? I mean, you think inflation is going to kind of moderate here in the back half of the year? If so, where will it moderate? Where will we see it?
Well, ultimately, I think it starts from the labor market on out,
okay.
Right? And, I think this sort of bottoms-up approach is interesting, and certainly that's helped people kind of nail the first quarter inflation data. But ultimately, I think you have to stick to first principles. And what I rely on is basically a standard triangle model of inflation. You have embedded inflation, or sort of inflation expectations. You have a proxy for aggregate demand, like the unemployment gap, and then you have some kind of cost push measure, right? Like exchange rates, import prices, something like that. So that's the standard triangle model of inflation that my former boss, Ethan Harris, taught me about many, many years ago.
Neill, you're reading my mind. Okay, here's what we're doing. Let me lay out the next 20 minutes. Cam Dawson's waiting. She's having a tantrum. She's not on yet. We'll get Cam Dawson on the markets. Futures up 42. It's a Cam Dawson market. But we're doing Neill Dutta. Yes, we'll get to the New York Giants. But first, Neill Dutta, right where I wanted to go was Ethan Harris. Neill Dutta, Dr. Harris wrote a blistering LinkedIn article yesterday saying, would everybody wake up, calm down, and looked at trim mean inflation statistics? Which is your favorite Ethan Harris adjusted inflation? Dallas Fed, Cleveland this, whichever. Which is Neill Dutta's favorite inflation statistic?
Well, Ethan has been harping a lot on the trim mean inflation. My pushback to that is that there's historically been a much higher, there's an upward bias in a lot of these trim mean measures, trim mean, median PC. They tend to run a lot higher than traditional core measures of inflation. If you go back to 2008 as an example, trim mean inflation was running a lot hotter than traditional core. And could you imagine what would have happened if the Fed was paying more attention to trim mean back then? At any rate, what I meant to say with the triangle model is that if you go through these components, inflation expectations after coming down last year, they've kind of stabilized this year.
Yeah.
Unit labor costs are slowing, right? And the dollar is stronger. So when you talk about slowing unit labor cost growth and firming dollar, how worried should we be about an upside inflation scenario? So I think you have to kind of stick with first principles, and you know, that's why I think the consensus should at least be open to the prospect of downside inflation surprises over the coming months on a magnitude of the upside surprises we got in Q1.